Okay, let's unpack this. Today, we are strapping in and soaring into the pretty exciting world of electric vertical takeoff and landing aircraft. eVTOLs.
Yeah, and this isn't just some sci-fi dream anymore. We're looking at a massive, tangible shift in transportation. Think about it. A projected market opportunity of, what, nearly $30 billion by 2030? That's huge.
$29.19 billion. Yeah, growing at something like 34% annually. Just phenomenal growth.
It really is the next frontier, potentially, for personal and urban transport. But let's be real. The front runners we're focusing on today, Joby Aviation and Archer Aviation, they're navigating some pretty speculative waters right now.
Definitely. Both are early stage, carrying significant operating losses, and, well, they largely came public via SPACs, right? Which always adds a layer of, let's say, caution.
Exactly. So our mission today is to cut through some of the hype, the marketing noise, and really look at their genuine strategic differences. We need to try and answer two core questions for you listening. Who's actually leading the race for that all-important FAA approval?
Crucial question. And number two, based on what Wall Street's saying and their business strategies, which one looks like the stronger investment right now?
And that FAA type certification, you mentioned it, it's everything in the near term.
Absolutely. Without it, all the cool designs, all the partnerships, they don't mean a thing for bringing in actual passenger revenue.
Not a dollar. It's the single biggest hurdle, the biggest catalyst, and it's where we see the first major split in how these two companies are approaching things.
Right. So let's start with Joby. They seem to have a clear lead in the core FAA process, the type certification itself.
That's right. A quantifiable lead, you could say. This process is the official thumbs up on the aircraft design itself. Is it safe? Is it airworthy? That's the question and answer.
And the latest reports, Q3 2025, I think, put them deep into stage 4 of 5 stages.
Yeah, indicating roughly 70% completion. That's pretty far along.
70% into stage 4. Wow. That's a monumental lead.
Like-
Puts them right near TIA, right? Type inspection authorization.
Exactly. That's the next big step, where the FAA's own test pilots get in the aircraft and evaluate it.
And they're hoping that starts, what, late 2025, early 2026 maybe?
That seems to be the target, yes. Their lead is significant because they've been doing piloted flights for a while now, and that data counts towards certification.
Okay, but it wasn't all smooth sailing. Their timeline, and really everyone's, got pushed back, didn't it?
It did. There was a bit of a regulatory curveball.
Yes. The FAA switcheroo. They pivoted from Part 2117A to 2117B. For those of us not deep in the regulatory weeds, what was the upshot of that? Why the delay?
Well, basically, the FAA decided these new eVTOLs were, frankly, too complex for the older, maybe more flexible rules under 2117A. So they shifted the standard to be closer to what you'd expect for established commercial planes.
Meaning more rigorous testing, stricter data needed, more traditional hoops to jump through, even for these novel electric systems.
Precisely. And that forced everyone, Joby included, to kind of revisit their data, their testing plans. It added about a year delay across the board.
Okay, so Joby's ahead on the plane certification despite that delay. Now, let's pivot to Archer. Their PEP certification progress looks, well, way behind. Only 15% complete as of Q3 2025. That sounds quite low.
It is significantly behind Joby on that specific metric, yes. But their strategy seems intentionally different, almost a counter move.
How so?
Well, while Archer is lagging on getting the aircraft design approved, they've actually already secured key operational certificates.
Operational certificates? Like what?
Things like Part 135, which lets you operate as an air carrier, like an airline,
Yeah.
and Part 145 for maintenance operations, and Part 141 for pilot training. They already have those.
Huh. But isn't that a bit like putting the cart before the horse? I mean, if the Midnight Plane, their aircraft doesn't get certified or it takes ages, aren't those airline certificates kind of useless? Seems risky.
It shifts the risk, definitely. You could say Joby is focused on proving the plane first. Archer is focusing on proving the business structure first.
Ah, I see.
Archer's bet is that the moment that final type certificate for the plane arrives, boom, they're ready. The certified airline, the maintenance, the pilot training, it's all greenlit to launch commercial services almost immediately.
So they de-risk the operational ramp-up, while Joby still has to get those operational certs after the plane is approved.
Exactly. It's a fascinating trade-off. Technical lead versus operational readiness.
Okay, really interesting strategic divergence there. Now, before we leave regulations, there's one big hurdle that hits both of them, right? Something that challenges the whole model.
You must mean the 45-minute IFR reserve requirement.
That's the one. Explain that.
So the FAA, being cautious, has applied a rule typically used for large helicopters to these battery-powered eVTOLs. It basically demands that the aircraft has enough battery power left to fly for an additional 45 minutes after it reaches its intended destination. Just for safety, for potential diversions.
With 45 minutes extra power, given battery limitations are already a thing, that must kill the usable range, right?
It severely degrades it, yes. It makes some of the planned longer routes potentially impossible. Or it means carrying fewer passengers or less cargo to accommodate that reserve battery weight.
So it fundamentally impacts the economics, the viability, not just the timeline.
Precisely. It forces them more towards shorter urban hops, where that reserve isn't quite as crippling percentage-wise. Less time making money, more time carrying regulatory safety margins. And this hits both Joby and Archer. Needs clever engineering or maybe future regulatory changes.
Okay, that really sets the stage for the actual aircraft. And here's where it gets really interesting, because the designs themselves, they just scream two totally different philosophies, driven by what they want the aircraft to do.
Absolutely. The specs tell the story, don't they?
Yeah.
Let's look at Joby's S4. It uses that quite complex but very efficient tilt rotor design. The propellers lifted up vertically, then tilt forward to act like a normal plane for cruise flight.
Making it highly efficient, especially for longer distances. That gives the S4 clear technical advantages for those longer routes.
Definitely. You're looking at a much longer range, maybe 100 to 150 miles, and a higher top speed around 200-mile-per-hour. Plus, it's lighter, about 4,300 pounds empty weight. It feels built for inner-city trips.
Okay, then there's Archer's Midnight. It seems to sacrifice some of that performance for, what, urban practicality?
Exactly. The Midnight uses separate sets of propellers, some just for vertical lift, others just for forward cruise.
Which is simpler mechanically, maybe, but adds drag.
It does add aerodynamic drag, yes.
Yeah.
Which is why you see a much shorter range, maybe 20 to 50 miles realistically, and a lower top speed of 150-mile-per-hour.
And it's heavier too, right? Max takeoff weight of 7,000 pounds? That's quite a bit, like 2 SUVs worth of weight almost. How does that impact things?
Well, that weight means higher energy use per mile, clearly, but Archer made that trade-off intentionally because the Midnight has this key feature for city operations, really fast recharging. We're talking 10 to 12 minutes.
Okay. So it's built for quick turns, high-frequency stuff like airport runs, get in, get out, charge up fast, fly again.
That's the idea. Optimized for that specific urban mission profile.
So the hardware really dictates the mission. And their manufacturing strategies are just as different, aren't they?
Polar opposites almost. Joby is going the vertically integrated route. Think capital intensive.
Like Apple, maybe. Designing and making most core parts themselves.
Exactly. They design, they manufacture components in-house. You can see the influence of their partner Toyota there that focus on controlling the whole process, give them huge control over quality, IP, maybe long-term costs. But it requires enormous upfront investment and time.
Whereas Archer's doing the opposite, more like a design house relying on a big manufacturing partner.
Precisely. They're leaning entirely on Stellantis, the big global automaker, for manufacturing. It's a much more capital-efficient path.
So Archer avoids the headache and cost of building giant factories. They leverage Stellantis's mass production know-how.
Right. Allows Archer to focus laser-like on design, certification, and hopefully scaling up production quickly. They've got ambitious targets, 650 aircraft by 2028 is one number thrown around.
That focus difference really shows up in their go-to-market plans, too. Joby seems very focused, almost premium.
Yeah, deep execution in key markets, and they plan to operate the services themselves initially. Look at Dubai. They snagged that huge 6-year exclusive air taxi deal there. They expect to start delivering planes for testing mid-2025.
And didn't they buy Blade Air Mobility's passenger business?
They did, which was smart. It gives them immediate access to existing helicopter routes and, crucially, Blade's high-paying customers, a ready-made market. Plus, the Delta partnership targets premium travelers.
Archer, meanwhile, seems to be casting a wider net, diversified.
Definitely playing a broader game. They're aiming for revenue from passenger services, sure, but also air cargo and significantly defense contracts.
That big Air Force contract, yeah, $142 million. And their Midnight design is apparently modular.
Supposedly easier to reconfigure for different missions, cargo, passengers, military uses, spreads the risk, and they got that big PR win too.
The 2028 LA Olympics. Official air taxi. Good visibility, especially with partners like United Airlines and Stellantis behind them.
But, and this is a really big but, underpinning all these plans, We need a reality check on the numbers.
The production and utilization forecasts needed to make the economics work.
Exactly. They are extremely aggressive, arguably unrealistic based on history.
Let's dig into that. Archer's investor materials, for instance. They suggest needing to sell something like 2,300 aircraft per year by 2030. Some decks even show numbers over 5,000.
Yeah, and you'd put that number 2,300 a year into perspective. Think about the entire mature global helicopter industry. In 2022, they sold just 932 civil helicopters worldwide.
Wow. So Archer needs to sell nearly 2.5 times the entire global civil helicopter market annually just a few years from now.
That's the scale they're projecting. It's an order of magnitude beyond what we've seen for new aircraft types historically.
And it's not just building them, it's flying them constantly, right?
Yeah.
The utilization rates.
Oh, yeah. Joby, for example, their models often assume their S4 aircraft will fly 2,500 hours or more per year.
2,500 hours? How does that compare?
Well, large commercial jets, like the big Boeings and Airbuses, average around 3,000 hours a year. So Joby's aiming close to that level.
With a brand new type of aircraft, battery-powered, needing fast turnaround, maybe new maintenance issues. That sounds incredibly ambitious.
It's extremely ambitious. Hitting those high utilization numbers is key to their profitability models, but it's a major operational uncertainty. Can they keep these things flying that much, reliably and affordably?
Okay, so that brings us right back to the core question for you listening. Which one looks like the better investment right now? Because if it was just about technical progress or who's furthest along with the FAA on the plane itself, you'd probably say Joby, wouldn't you?
Hands down on that specific metric, yes. But Wall Street, well, Wall Street often cares just as much or maybe more about valuation and perceived speed to market.
And we really see that reflected in the analyst ratings, don't we?
Very clearly. Archer, despite being behind on type certification, currently has a strong buy consensus rating. That's 16 buys, 1 hold, 0 sells.
And their average price target suggests quite a bit of upside, over 40%.
Yeah, analysts seem to like their more disciplined spending, those big partnerships, and their hefty cash reserve, about $1.7 billion.
Meanwhile, Joby, the technical leader, has a more cautious hold rating overall.
That's right, more holds than buys, 24 holds, 8 buys, 3 sells. And their average price target actually implies a potential downside of around 12%.
Why the caution there, despite the FAA lead?
Mostly concerns about their higher expenses, their cash burn rate, and maybe less consistent earnings performance compared to expectations over the past year.
Let's look at those financials. Joby's Q2 loss was pretty big, right?
It was a net loss of $325 million. Their estimated annual cash burn is running somewhere between $500 and $540 million. That's a lot of cash going out the door.
And Archer.
Still losing money, of course, their pre-revenue, but their Q2 net loss was smaller, $206 million, and their burn rate seems more controlled, around $123.5 million quarterly. That translates to more runway before they potentially need to raise more cash.
And Wall Street seems to be betting Archer can ramp up revenue faster using that Stellantis partnership.
That appears to be the bet. Analyst projections show Archer going from basically 0 revenue in 2024 to maybe $416 million by 2027.
Compared to Joby, projected to go from very little, $136K in 2024, to about $130 million in 2027.
Exactly. That faster projected ramp-up for Archer is a big part of why their valuation looks more attractive to analysts right now.
Let's talk valuation multiples. This is where it gets stark.
It really does. Despite Joby's technical lead, its stock trades at around 98 times its projected 2027 sales.
98 times.
Whereas Archer trades at only 15 times its projected 2027 sales.
Correct. 15 versus 98.
Okay, break that down. What does that huge difference actually signal in terms of market expectation? Well, in simple terms, the market is pricing Joby for near perfection. That 98x multiple means investors expect them to execute flawlessly, capture massive market share, and basically become the dominant category killer to justify that price. There's very little room for error baked in.
And Archer at 15x?
That's seen as much more reasonable by comparison. It suggests Wall Street sees a wider range of outcomes, perhaps acknowledging the risks, but also seeing more potential upside if Archer does manage to hit those ambitious sales targets fueled by Stellantis. There's more margin for error, potentially.
So, boiling it down for you, the listener, Wall Street at this moment seems to favor Archer as the stronger buy. They're looking past Joby's current technical and FAA lead on the aircraft itself and focusing more on Archer's valuation, its manufacturing strategy, and its cash position.
It really highlights the two very distinct paths these companies are carving out. Joby betting it all on technical superiority, vertical integration, targeting a premium market.
And Archer, going for capital efficiency with that Stellantis partnership, diversifying its bets across different markets, aiming for speed and scale.
This rivalry is fascinating, and it's shaping this whole new low-altitude economy.
Yeah.
But there's still that giant elephant in the room, isn't there? A structural risk over the whole sector.
You mean whether any of these companies can actually achieve the necessary scale and utilization to make the business model work long term?
Precisely. Both business models rely entirely on achieving production volumes and flight hours per aircraft that, frankly, history suggests are incredibly challenging, if not unprecedented, for a new aviation segment.
Especially when you remember that most of those big orders everyone talks about are still conditional, not firm, locked-in purchases yet.
Exactly. So the ultimate question isn't just who gets certified first or who has the better balance sheet today. It's whether this whole new regulatory environment, combined with an unproven business model demanding massive scale and near constant operation, can actually sustain these high valuations and intense cash burn rates.
So, a final thought for you to chew on. What technical or commercial risk do you think is the single biggest barrier standing between us and that potential $29 billion eVTOL future?